If you want to get higher returns, you move away from public assets, and you move more to private assets where you can get sort of 8%, 9% returns versus like 4.5% on listed bonds.
But isn't that partially a function of further up the risk curve?
Yes, there is a credit quality aspect as well. Given that this is, portfolio managers managing their exposures, they'll be able to manage and mitigate those risks because of the handouts that we saw. So we've not gone through a recession yet, so nobody knows what that looks like. There will be some volatility, but maybe it will be less than what you see in the high yield space. So maybe on a risk return basis, it looks pretty attractive.
Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And today is an interesting topic, right? Because I think over the past few years specifically, I'm seeing more and more private equity placements, structured investment products that are so-called under the mantra of democratizing finance being pushed into retail investors, especially the higher earning ones, which is a lot of our audience, right? So you see that big move, right? And when I look at it, I was like, why? What's going on, right? And like, how do I really evaluate these products, right? Because to be fair, the high net worth use a lot of these products, but if we want to tap into it, like what do we need to look out for and all that jazz, right? So that forms the basis of today's episode, alongside some other expanded investment ideas. And we have Steve in studio with us, with my favorite co-host, Anthony, right? So for everybody that don't know you yet, right? Could you just introduce yourself?
Okay, so my name's Steve Bryce. I'm the CIO for Standard Chartered Bank based here in Singapore. So I run a team of around 40 people who advise people on how to invest their money and also manage money on clients' behalf. Been with the bank for 27 years, so a decent innings. So vast majority of that, over 20 years in Singapore, but also stints in Dubai and Johannesburg as well. So yeah.
Great. So why are you in Singapore then?
So obviously the bank is global headquarters effectively. I mean, its primary listing is in the UK, but most of the businesses run out of Singapore. So it makes total sense for me to be based here as well. Asia is like 70% of our business. So yeah, Singapore makes sense.
Okay, fair. So when I first started the episode, I kind of laid down that idea, right? Where a lot of private equity and, structured products are getting introduced to the market, especially amongst, our audience, right? High earning individuals. They're not like high net worth shaking their leg, right? But they're working hard and making decent money.
They're barely qualified to be an accredited investor.
Yeah.
Right?
Like maybe 5 more years, they'll be an accredited investor. So they're all kind of on the fringe. Sometimes it gets a little bit exciting because when you think about, oh my God, once I get an accredited investor, I can open up to all sorts of all these other things. So I'm like, okay, relax, right? Excitement is one thing, but trying to understand what's going on is another thing, right? So is this like a trend that you're also observing?
Yeah, so maybe sort of talk a bit about why it's the trend, right? So obviously what we've seen in over the course of the past 10, 15 years, obviously bonds until very recently were yielding negative real rates. Forward-looking assumptions on capital market returns were very, very low. They've obviously improved a little bit, but now equities, public equities, the forward-looking returns look fairly meager, right? So if you look at global equities, you're looking at around maybe 5% annualized returns going forward. And you go, well, the 10-year bond yield is what, 4.5, whatever. You go, why would I be in equities again? And there is a reason, right? Of course, because they're inflation protected, so you need to have an equity allocation in your portfolio. But then you go, okay, is there any way I can juice up the returns? And you go, okay, well, if you want to move, get higher returns, you move away from public assets, and you move more to private assets. So from our perspective, a big play has been into private credit, right? So where you can get sort of 8%, 9% returns versus like 4.5% on listed bonds. So that's much more attractive. And then obviously, as you say, the next play will be into the private equity space as well.
Yeah, but just to explore that assumption a bit, right? So I get that private credit has better returns than investment grade bonds, but isn't that partially a function of moving further up the risk curve? So you're not kind of comparing, investment grade borrowers with investment grade borrowers. They are broadly diversified, yes, but your credit quality is somewhat different.
So I think there's two aspects, right? So obviously that one is this floating rate, right? So as yields come down, then clearly it will become less attractive. But yes, there is a credit quality aspect as well. The assumption, which is yet to be tested, is that given that this is portfolio managers managing their exposures, that yes, on paper the creditworthiness is not so great, but because they have such good collateral and good relationships, et cetera, that they'll be able to manage and mitigate those risks to a significant extent. Now, we have to acknowledge that in private credit space, this really only took off in the post-global financial crisis world when banks were very clearly pulling back on balance sheet lending. Yes, correct. So they're being disincentivized from lending, right, through high capital and liquidity requirements, right? So we've been through COVID, right? So that was looked like it was going to be a significant stress test, but it lasted like 3 months from a market perspective, because of the handouts that we saw. So we've not gone through a recession yet. So nobody knows what that looks like. The presumption is that yes, there will be some losses, obviously. There will be some volatility, but maybe it will be less than what you see in the high yield space, which offers similar sort of yields. So maybe on a risk return basis, it looks pretty attractive.
Yeah, and I guess that, given that you're a private credit lender, you have a bit more control over your covenants, you have a bit more ability to do a restructuring and a workout compared to a public bond, right? Because of just how bond liability management works.
Yeah, I suppose there's also the fear that you can manipulate what things look like a little bit more by extending things on favorable terms just to not take a hit in the portfolio. So there's a little bit of concerns there.
Yeah. Please expand a little bit. Like when I think when our audience here will manipulate, right? They'll be like, what what is this, right? So
I guess if somebody can't make an interest rate payment, right, then you can roll that into a new loan. So obviously higher nominal value, and therefore it never shows up. Obviously, and we see, you can look at, that happening in different emerging markets, for instance, right? You see banks perpetually lending and not acknowledging that they've actually got, NPLs. So that's obviously a concern in the private credit space. We haven't really stress tested that, at least as far as we're concerned. We haven't seen any stress testing of that yet. But obviously, when we get the next recession, that will be the thing to watch out for.
Maybe let's take a step back, right? Big picture perspective, a lot of people, I would say, especially the prevailing notion now is, just buy broad-based market index, S&P 500 or VWRA, maybe add some bond allocation, although if you're young, you don't really need it, and you DCA and that's it, right? You set and forget and you do this for 20 years. The question that always nags at me, especially, as my salary goes up, as my pot of savings goes up and I get pitched more products is, well, do I really just buy a standard public equities, public bond, 60-40, 80-20, whatever allocation and set and forget? Or is there something more? Because you can imagine, right? As you get older and older, as your pot gets bigger and bigger, you kind of shift away from accumulation to trying to be a bit more defensive, right? And people will say, oh yeah, that's when you move from 80-20 to 60-40, whatever. And then all these other products are just fee suckers and useless. I'm a finance lawyer, right? So I know enough about these things, but somehow they are actually really complicated. So I thought, yes, this is something that I do want to come in and hear for. So maybe that's the question, the initial question for you. Do you see there being a particular use of the alternative products? And when do you see these, becoming more and more helpful, I guess? Or where do you see the place of these products in a broader portfolio?
Okay, so maybe let's start from the sort of 60-40, 80-20 conversation first, right? So obviously that got a really bad rap in 2022 when both equities and bonds sold off at the same time. That's extremely abnormal. So we describe that as the second worst year from an investor perspective in the past 150 years, right? The other one I think was 1931. Where equities were obviously down absolutely massive and bonds were down slightly. So slightly different mix this time. But it was not unprecedented, but it's extraordinarily rare that you see something like that. So I think for most people, a 60-40 or that type of structure is pretty decent, right? So if you just do that, especially if you're very focused on your job, you have no interest in finance, etc., I think that's a very good starting point. And even for those that are interested in finance, actually, it can be a very good starting point. But given where we are today, as we said before, with expected returns where they are, there is a case to be made for then broadening it out. So we have foundation allocation, which is just long only.
Yep.
So basically cash, equities, bonds, gold, right? Very simple. And then we have foundation plus, which then includes private assets and alternative strategies and stuff like this. Once you get into that space, there's two things that happen. One, yes, your expected returns go up, but your risk increases. right? Not the way people normally measure risk, I would say, right? Because people would usually say, okay, what's the correlation of these assets with other asset classes? Does it improve my risk-adjusted returns? And if you look at the index or asset class level, you go, yes, absolutely. So actually you add private credit and private equity to a foundation allocation and you get higher returns and lower risk.
Risk in terms of lower volatility?
So measured by, typically measured by volatility. Yeah. So obviously, and some of these, as we mentioned in the private credit space, we don't have a lot of historical information here going through the cycle, right? But that's how we model it and how it looks to us, right? But then you get a different type of risk, right? So if you invest in let's say you in a US equity fund, you're going to get the index plus or minus 2-3% most of the time, right? And you get fees in there and stuff. So probably skewed slightly to minus than positive, but you know roughly what you're going to get. Whereas if you go into private equity, you could get minus 100% or massive returns, right? So I think from that perspective, then it becomes, okay, I'm being charged very high fees, right? So I need to be pretty sure that I've got the right guy.
Yeah.
Or I can at least diversify that risk sufficiently. And I think that's where people who are on the threshold of becoming an accredited investor probably struggle to diversify their risk that much, right? So then you talk about private equity funds and those sort of things to try and spread the risk. That means you're less likely to get the home runs, but you're also less likely to be wiped out. But it gets quite complex really quick.
Yeah, and that kind of leads to the broader question, right? Because I get that, let's say you have somebody who's barely an accredited investor, 1.5 mil, saying, 100K into a PE fund is relatively chunky. It's not huge, but it's something that people would think really, especially from a liquidity perspective, to put in 100K in cash. And I get a point about kind of diversifying a bit more and therefore spreading that risk. But then at the end of the day, if you go to a PE fund of funds, isn't that just taking general economic risk? And you go back to being very correlated to your S&P 500, save that you don't have mark to market every day.
I think you do get benefits from it still, right? So you're basically narrowing the tails a little bit, but you should still be roughly towards the center. There may be a slight increase in fees by doing it that way. So then, you may skew it a little bit to slightly worse outcomes on average, but I still think there is benefit to it. I just wanted to come back to one of the point you mentioned though on the liquidity risk. I think people overestimate their need for liquidity.
Yeah.
If you're an accredited investor, presumably you're still working. If you're tying up 10% of your portfolio into here, I hope you don't have to eat through the first 90% such that that 10% becomes material. Otherwise, you've got bigger problems. I think that's right. So, two of the biases that we find with our clients are, firstly, yes, I'm tying up for 7 to 10 years. Is that okay? I think the real question they're asking actually is, what if it goes wrong? Right? It's not actually that I'm tying it up. It's tying it up in something that could go wrong. And then it's on my balance sheet for 7 to 10 years. That's I get that more than just the narrow liquidity risk question. So I think that's the sort of key thing that I just thought would be interesting.
Okay, before the conversation just runs away, right?
You want to bring us back?
Yeah. Okay.
He's here just to focus.
Yes. Just to kind of ground our audience a little bit, right? So I think everybody kind of knows what's private equity, right? Like certain interesting companies, you invest in the early stages and then it goes through multiple series. Hopefully it exists in the market and then you can get a big exit from there, right? That's kind of generally how people think about it, right? And then could you just kind of lend us on funds of funds, some of these things, like how do these things work? What are they looking at? Not to the basic, but just kind of so that our audience get a general sense of what is this?
I guess there's 3 broad ways that you can do private equity, right? So one is source an individual deal and do it. Right. So in the private bank, we're progressing on that place where we can get co-investments with private equity house, but you choose the deal that you invest in. Right. So that's quite interesting for a lot of people because you say, instead of, to your point, spreading the risk, I'm taking a risk that I feel comfortable with. Maybe I have knowledge of that industry, that sector, or actually I don't, but I want to diversify away from the sector, and both are valid ways of looking at it, right? So actually doing specific deals and then taking full accountability and participation in that. Then you get a PE manager, right? So that's just saying, okay, this guy's had a good track record. I trust him, therefore I'm going to give him my 100,000 and he's going to invest that for me, or million, or whatever it is, right? But obviously, we all know there's a possibility that could have been historic performance, could be luck. And we all know private equity, usually 1 or 2 deals make you money. 7 you lose money and the other one breaks even, right? So it's something like
That's
that.
like the game, right?
So
yeah.
if one out of those 1 or 2 deals doesn't turn positive, then suddenly you don't look so great, right? And I guess that's the concern that people have. So you say, okay, this guy's got a good track record, but maybe I've got a 70% degree of confidence that he's going to replicate that going forward. That 30% is a bit worrying. Maybe I should diversify that risk. And then that's where you get the fund of fund, because you get 5 portfolio managers, private equity managers that historically have done well. And you think, yeah, they can replicate their returns. And maybe that confidence level goes up to 90, 95%. And then that gets, you know, as I say, you may reduce the tails, but at both sides. And that might be something that people are interested in.
And that's extra layer of fees, right? Fundamentally from...
Yeah, I mean, obviously, you know, the finance industry is,
bankers need to eat too.
Yeah,
human.
The only thing I would say is it's still not cheap, right? But I think there is an increased competition coming through in the private space, right? So therefore, those fees aren't done and dusted, but they're increasingly coming under market pressures for being revised lower.
For sure. I mean, even Temasek has his own private equity fund, right?
And they have moved away from becoming purely an LP that pays fees to trying to get co-invests, right? Where they take a bit more of a stake, a bit more participation, and they pay less to the person managing the fund.
Just to highlight on this, right? Because I think there are always the very big established fund houses, right? That will do all these kind of stuff. But there are also a lot of upstarts, right? That come along and then they will do like small little funds. Maybe they are Series A, Series B, whatever. And then they'll focus there, right? And I think it's important for our audience to realize, right? That there's actually a lot of funds in the game, in the PE space, that they will raise a very small fund to start with. And then they will invest in relatively big projects that have a very high level of certainty that they will succeed. To then, say that, our first fund is very successful, right? Of course, right? Because you invest in D, you're about to exit. So, first fund is very successful. And then they will take on some of these big names within their marketing brochures. And then they will raise a bigger fund to do even like crazier things, right? So I think just wanted to highlight for our audience, these are some of the mechanics in the private space that you should be aware of, right, when you're evaluating.
Yeah, and we're talking off air about, you mentioned the need to do due diligence. What does that mean, right? And the reality is, if somebody comes to you and says, okay, we've got this new guy coming in, he's really good, he's got backing from X, Y, and Z. What makes you confident this guy knows what he's doing and he's going to do well in the future? And I think that's something that you have to really ask yourself. And men are worse at asking this of themselves than women. We're generally more looking at the positive side of things, right? And looking at the upside possibilities, whereas women sort of have a bit more of a risk lens as well. So I know that when I talk to my wife about some of the investments.
I should just ask my wife before I do
Your
anything.
wife should be participatory.
And firstly, this is based in academic research, right? So this is, I'm not being sexist here. This is just, it's true. But I think it also means that if you have a significant other, you should go on that journey together, because, you're going to have to make decisions on whether to stay with an investment or get out of an investment together as well. So I know from personal experience, I generally look at the portfolio across the whole board. So if one line's negative and the rest are positive, I'm like, yeah, okay, that's pretty cool. My wife zooms right into, why is this fund not delivering positive performance? I thought equities were already up over the past 3 months. Yeah, it's okay, don't worry, it's cool. But you have those conversations. But I think they're good conversations to have, because it forces you to justify it, right, to somebody else. And then if you can't justify it, you like go, maybe
you have a point.
Yeah,
give me a moment, I'll get back to you, right?
Even as a CIO, that occasionally happens, right?
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And we'll see you for great content on Chills with TFC. Okay. Can we elaborate a little bit more on the foundation plus side of the, because foundation, based on what you've said, equity, bonds, cash, go.
I'm a bit curious why gold is there, but we can
we can go there first.
Just on foundation. Why gold? Why not broader commodity?
Yeah.
Right. And in terms of gold, what sort of allocation and what kind of role do you see it play in the portfolio? Like cash, equity, bonds, kind of self-explanatory.
So actually, if you look at over the past 10, 20 years even, gold, portfolio construction perspective, has done a stellar job, right? So it's delivered returns not too dissimilar from equities, right? You just say that statement on it going, how can something that generates zero cash, right, do that? And it's had a very, very strong performance. It does also diversify significantly some of the risk away. So look, in our portfolios, we have a 5% core allocation. So neutral allocation is 5%. At the moment, we're overweight. So we have a sort of 7% allocation. So it's not overtaking the whole conversation.
So it's not 30, 40%.
Yeah. But we do believe that it's it does have a role to play. Obviously, it does give some long-term inflation hedge, as do equities, of course. So we think it does have a significant value to add from a portfolio construction perspective.
And then moving on to Foundation Plus, you add on private equity and private credit.
So if we're looking at a balanced allocation, we'd say around 25% goes into private assets and other alternatives, so hedge fund strategies, right? So hedge fund strategies would include equity long short, event driven, so M&A type activity, macro CTA, which is one of the hardest areas to get right, right? Everybody knows that it makes total sense, but it's like an insurance policy. You pay almost every year and then it does really, really well for you, right? And most people don't hold it until it does really, really well for you, right? So that's
because it will be negative every single year except for that 1 year.
Yeah, correct. So, it's an insurance policy. I guess that's what if you look at Nicholas Nassim Taleb, he says you should be long the wings, right? So you should be long extreme outcomes. And that's exactly what macro CTA does, right? So, yeah.
Okay.
And sorry, that's a 25% kind of private
for total for all of that together.
Wow. So but why that figure? I mean, from commodities being 5 to 7, you can see, it's small, it's a small diversifier away. Then why would private, as you move kind of a bit further up, why would the private assets take up comparatively a much larger chunk, I guess?
So I guess it comes down to the gold. If you look at the expected returns, I mean, it's massively outperformed expected returns for the last 10 years. So it could happen again next 10 years. But if we look at forward-looking expected returns, you're probably looking 3 to 5% for gold, right? So it's not super sexy. Whereas if you look at the private equity and private credit space, the expected returns are much higher. So from that perspective, they're obviously cash flow generative. They both actually have good inflation protecting characteristics as well. So private equity, obviously, but even private credit, because it's floating rate plus a significant margin, then you can argue that if interest rates go higher because of inflation, then you'll get some protection through there as well. So I think from that perspective, that's why we sort of have a bigger slant towards that. It is focused more on private equity and private credit. So those would probably take, I'm trying to remember the exact numbers, probably 2/3, maybe even more of that allocation, of that 25%. And then hedge fund strategies, the remainder. So yeah.
And I guess for hedge fund strategies, it's a bit more like gold, where you don't really look too closely at how the sauce is made, and you go, we know that the returns are, because of the strategies, because of how they are run, the returns are going to be diversified from the rest of the portfolio.
Yeah, and I guess that's where, often if you're talking about, let's say, a 7% allocation to hedge fund strategies, then you go, okay, so I've got 4 categories. Do I allocate like 2% each? What does that mean? Okay, is that sufficient?
It feels like you start getting bogged down in a lot of very small details,
I think
right?
We love to overcomplicate matters as finance experts, right? So we love to go, the theoretical frontier is this, and that's, it should be 1.8%. And like going, I've got 1 million. Do you understand how much work I have to do to make the right decision in that space? So let's not try to overcomplicate it. So in that space, I think a multi-strat approach in the hedge fund space, that maybe even asset allocates within that on your own behalf. So it has a model where it sort of says, okay, I should be allocating more to, let's say, equity long short. Then that can make sense. But again, then the fee conversation comes up, of course, right? Because it is not cheap.
So I think realistically, for our audience, right, foundation is foundation, right? And then when they enter the foundation plus space, if they were to explore this, likelihood it's private equity, private credit, right? We kind of play around there
and
first.
probably private credit first because it's easier. It's easier and it's more liquid. So coming back to that, and actually the deviation between managers will be lesser, I believe. I think still value that can be created in that space. I'm not saying an ETF of this space is going to be best, but I do believe we're seeing a lot of entrants into that market. I think some will do a better job than others, right? But if, let's say, the asset class delivers 9%, I don't think you're going to get some people delivering minus 10% and some delivering 20%, right? I think you'll see people delivering 4 or 5% and some delivering 11, 12%, that sort of thing. So just, I think that's probably a bit safer. And of course, you do generally have quarterly liquidity, at least. There are gates. So there are potential risks that you won't be able to sell when you exactly want to, if there's a market event. But, generally you have some sort of liquidity there. So you're not tying your money up for 10 years. At least mentally you're not.
Fair. No, because I think private equity sounds very exciting, right? It's all these big ideas, all the shiny objects, right? And then there are like 101 events tied to private equity things, right? So it's always very exciting for a lot of people, but as you dig deeper, as you understand, the lockup is very serious because the companies need time to grow. They need to go through multiple rounds before they exit. There's all sorts of other weird things.
Exit has been getting harder, right? That's something that
we've
got in the
industry. IPO exit, at least for the past 2 years.
Yeah, so many down rounds in the market.
One of the interesting pieces and another reason to think about private equity, but it's also potentially a headwind in the future as well, is saying more and more companies are thinking about not being a publicly listed company. They prefer not to have that greater transparency, shareholders, so they're quicker to make decisions and more unfettered, if you like, when it comes to making decisions. And obviously, X is one example of that, but you've got other companies that are doing that, and that's making that IPO exit more or less attractive to some people. So you can have the greatest company, but then how do you get away with it? And now you've got basically a roundabout of people, private equity houses basically buying stuff from each other. Right. And this is really interesting because we've never really seen this before. We've always seen that the IPO exit was a risk because what happens if at the end of that 7-10 year period, it's a recession? So people, you're not going to IPO into that. And then you become, okay, it's going to be a 12 year until markets recover. Now you're getting to the point where you're saying, do I actually want to IPO or not? So if you want access to all areas of the economy, you want access to private equity because increasingly the stock market is not representative of the economy. But then also how to actually monetize that view or monetize that exit is really interesting.
Exactly, right? So if let's say IPOs are not going to happen as much, what is the mechanics now? Are we just going to sell to another fund and then we encash it? And then what is the situation, for how you would develop?
Yeah, it's going between the private equity because I think people hadn't envisaged this happening. What I wouldn't be surprised if what happens in the future is, private equity houses then actually sell their company to an individual investor rather than IPOing. So let's say they have this tech startup, which is obviously what we have in mind when we think about private equity, right? Then they say, okay, fine, the company has done this, it's done really well, but now, we need to exit it. And then you go to a SoftBank or you go to a X or whatever and say, do you want to buy this? Right. So it stays private, but at least you have an exit strategy.
So you kind of find a strategic, patient capital.
Yes.
Right. Like Temasek, GIC,
So how does that then affect my models, right? Because there will be no more 1000x exit in the IPO market, from that point of view.
You could still get 100, 1000x because you go in earlier stage, right?
Okay,
so your returns are driven not only by capital markets exuberance, when you IPO, which you always tend to IPO more conservatively anyway to get the first day pop, but also the growth in the business, right? Or if you are PE and you're doing roll-ups, just combining 10 small companies into one and saying that, we have economies of scale.
We're a conglomerate, we can list now, right?
Or we are more sizable now in the market and we can sell it, right? And we can get all these network effects.
We see it, right? So many of our friends are getting rolled up together. So we know.
And usually when you IPO, people want to have a successful IPO. So they actually try to price it a little bit below our market so they get a buzz on the launch. If you're selling it private, separately, then you probably don't need to worry about that much.
So you may even capture it even bigger.
We don't.
We don't know yet,
we
right?
don't know.
Yeah.
I think the answer is probably both. In some circumstances, you'll get more from a private sale, and sometimes you'll get less, and that's just the way it is.
Okay, fair. Interesting. I really enjoyed that. So maybe we can talk a little bit more about private credit, right? So because right off the gate we went for it, I was like, what's going on, right? So maybe
I'm a debt person, so I love it
all the way, right? So maybe just kind of establish, for us, right? Like how does these things work? Just kind of like a framework for our audience to understand.
Yeah. So basically, it's floating rate debt, obviously agreed bilaterally between the fund and the guy who needs money, which obviously actually often in the private equity space, right? So you're like, so we're sort of looping back to that conversation. So the need, maybe if we just go back, why did this come up? And basically it was because when you're running a company or whatever, you need long-term financing. This is floating rate, but it's still, through, 2-3 years financing. And the banks were, hamstrung in terms of willingness to do that. They take deposits, at shorter tenors. And we saw during 2022 what challenges that can create in terms of the for the banking sector, but we obviously saw it in real in 2009. So they basically withdrew from that market, and so then the people came up with this idea, of course, saying, well, a fund has captured market, has people's funds tied up in it. So then I can take that duration risk, if you like, or that it's not tenor risk, because I've got funds locked in for a period, and I can, as I say, you can gate them. So if people want the money out and I can't give it to them, then I can stop them bringing it out. Whereas a bank, you obviously can't do that. And so that's where it all came from. So it's just due to the liquidity mismatch risk from the banks, and they found a different way to do it.
Okay. So that is essentially the base of the product, right? Which is private lending, right? So there's a lender that probably finds it maybe a bit cheaper or even more strategic to lend in the private space, then they'll lend from these funds, right?
Yeah, and from a borrower perspective, they like it. Although they often pay a higher interest rate, actually, they like it because it's more flexible and they can be more reactive. So if I go to the market, I have to have a huge perspective. I need to hire lots of lawyers.
Private credit hires lawyers too.
Actually, that's very true, right? But I think the lawyers are probably a bit more nimble, and because there's less scrutiny of the work, right? I mean, in terms of so you launch a bond prospectus, there's a lot of legal requirements in there. If you mess that up, you can get into real trouble. So I think that's why much more able to raise money quickly if they need to.
The mechanics is simple, right? It's not too
difficult, yeah.
But from an investor standpoint, right? How is it then delivered to me? How is that product structure on my end?
I mean, wouldn't you just like to be a bank? Like banks make money, right?
Yeah. So
that's the reality. If
so that's the business, right? Lending, right? Essentially, right? But from the product standpoint, like how do I interact with the product?
No, so you're just an investor in a fund which lends to corporates, right? Yeah. So it's like investor into a fund which buys equity, and that's private equity.
So and then the fund will charge me a management fee.
Yes.
That's the mechanics, right?
Yes.
Okay.
Which won't be private equity like, right, in terms of the fee, but it will be like a mutual fund.
Okay. For our audience that for some reason don't know, right? Like what is the kind of structure? Like how does it usually look like?
So for private equity and hedge funds, there's usually this 2 and 20, right? 2% and 20% of the gains, right? They don't, for some reason, don't take 20% of the losses when they occur, but I never really understood that, right? But then obviously on the mutual fund, so it's a lot lower. So it's, probably around 1% or something like this. You probably charge an upfront fee to start with and then a management fee thereafter, right? So it's not an ETF. And I know people are trying to move ETFs into that space. Really interesting. But once you look at the economics, even with those fees, it still looks pretty good.
Yeah, and I think a kind of a point to distinguish is that private credit funds have their own strategies as well, right? You can aim at lending at different sectors, at different types of borrowers. There are some private credit funds that further up the structure. So they are mezz lenders and they want 15-20% returns, right? So yes, it's debt, there's a bit more control. You are higher up in the cap structure compared to equity, but it doesn't always mean that all private credit funds are safe. Different credit funds have their own risk profiles and, niche in the market that they want to target.
And the IMF I think they will ultimately be right. A lot of money is going into this space, right? So this market has gone from nothing-ish 2008 to very, very material. I forget the exact numbers, but the growth has been exponential and is continuing. So the fear is that creates risks for the financial system, right? First, so shadow banking system, I guess. And ironically, there is a layer where banks actually lend to the private credit guys, right? So I still think it's less risky from a financial sector perspective than the banks doing it themselves, because there's an intermediary and there's more diversification, etc. So the banks are less likely to be hit by it, but it is there. Probably what's more likely is as more money chases the same amount of deals, or then the pricing of those deals gets more competitive, and then the risk return changes. So maybe in 2-3 years' time, we'll be talking about, private credit, still looks good, but expected returns are 7% rather than 9%. You like go, okay,
Do we need
but
that now,
then we
right?
come back to, well, isn't this high yield?
Yeah.
And so
you charge me 1%
these things
on
go
top
around
of
in a second,
it.
and then we were like going, okay, so are we going to do private debt squared or something like this, right? I mean,
I know.
So I think ultimately this space has been so successful from both a performance and a marketing perspective that money is going into this, and at some point, I don't think it's in the next 1 or 2 years, but ultimately that's something to worry about.
Yeah, it's definitely. Okay, that's cool. And I think just kind of rounding it back to where our audience is at, right? So they got their call going. This looks interesting, and that's kind of like the plus element. And the plus element kind of changes over time, right? Which is essentially what you brought out, right? Okay, there's this thing that's happening, let's kind of see whether we can capture it, right? And then after a while, maybe it's, a little bit of exuberance, or maybe the market has already, maxed out whatever it can do. And then there's a, reversion back on it. And then we kind of change some of those things, right? So in some ways, it's still like the core, and then like we go further, right? So that's kind of where things are.
Yeah, the way we look at it is we see private assets as part of the core, right? So part of the foundation portfolio.
Fair, I get it. So maybe in closing, right, I would love to hear your point of view of like the broad market. Where are we going? From your optics, how are you looking at the global markets moving along across the board? Where are we on this? Yeah.
I guess from our perspective, we're actually a bit boring in terms of our views.
Boring
now,
doesn't
right?
mean it's bad, yeah? Just to be clear, right?
Yeah. And it's because we're largely neutral across the board. So we're underweight cash, overweight gold, which, as we've just discussed, are small asset classes at the fringes. The main area is bonds and equities. We have a neutral allocation. That doesn't mean neutral, they're not going to do anything, but we struggle to make a strong case for preferring equities over bonds, or vice versa. And the real reason for that is equity markets are not cheap, particularly in the US. Right. And so from that perspective, we if we look again, going to forward-looking assumptions, they could do well, still got some tailwinds. So we do have a central scenario that we'll have a soft landing in the US. But obviously that to some significant extent is already priced from a market perspective. So we're sort of saying, look, you should still be exposed to these. We still think equities will do okay, but supersized returns are unlikely. And obviously bond yields now are increasingly competitive, and that's increasingly the case after the Trump victory, obviously last week. That is a pretty, we've seen a spike in bond yields. So actually from a tactical perspective, that's the number one call we have, is saying actually add to bonds today. Right. And high quality bonds in particular, because, central scenario is a soft landing, but we still have a 25% probability of a recession. So let's just take the risk maybe on the equity side, but don't take it as much on high yield or on the fixed income side. So that's the way that we look at it. From within equities, we see Trump's likely policies as leading to US outperformance. So we talked about valuations being concerned, but at the end of the day, if you've got increased tariffs, which we believe means a stronger dollar, and you've got tax cuts being maintained, although that's less of a tailwind as it was in 2016, of course, because they're not being cut, they're just not being hiked. I mean, there's some analysts starting to project cuts, but I think that's going to be tough. I mean, he might get something done.
I think the money is already in. They don't really need to cut more, but that's a different story.
Yeah, but we'll see, right? Yeah, obviously, we're assuming they'll get the house, right? So they may be able to do something, but I don't think they'll do 15% or anything like that. They might cut from 22 to 20, which would be probably enough to give a fill up. So we're still overweight US versus everywhere else, right? So Europe is the bottom of the rank, but the US we expect to do well. Historically, when the dollar appreciates, US equities outperform everybody else, and we just expect that to replicate.
Just to hear your thoughts, right? Why is Europe the bottom of the rank? Just share your perspective.
I think they're really struggling to find now an economic model that's going to work. So obviously Germany has always been the economic powerhouse of that part of the world. And, I think China is really hurting them on two angles. So one is China's not strong, right? So the goods that were being exported, the machinery orders and stuff like this that were going to China are being sought after less. And then obviously the car industry in Germany is struggling under the EV conversation, right? Which part of me says cheap EVs is good for humanity, but obviously it's not fair competition for the rest of the world, right? So it's difficult. So I think, Germany, historically, their powerhouse struggling, and the rest of Europe, even where they've got strength, are pushing back. I mean, not really important for the stock market, but the tourism industry, you're seeing a lot of pushback on excessive tourism.
Yeah, people are unhappy, right?
Yeah, so I think they've got all of these issues going on, and the central bank is probably behind the curve. So and you're not getting fiscal stimulus coming through. So it just feels like the economic story, despite cheap valuations, we have to acknowledge that if there was a change in those fundamentals, or even a stabilization, Europe would probably do very well, but we're skeptical at the moment.
Yeah, it feels like they're cheap for a reason.
Yeah.
But I mean, we've learnt with China, yes, they were cheap for a reason, but they're massively underowned.
Yeah.
Right. So you get to that. So I'd say Europe is underowned. I mean, the UK is underowned as well. So when you go from absolutely dreadful to just dreadful, that's when you make huge money. And there's some element of that, right? You saw that in China. What have they done? I would argue, they've eased policy a little bit. They've given promises, but they haven't done. I don't think they've done enough to turn the ship around.
They have spoken more than they have acted.
I always get interested when people say uninvestable, because like going, very few things are uninvestable. What's going to happen? But we couldn't see what it was going to happen, right? I mean, I was in front of TV in January when China's going to bounce, right? So we could get to that point in Europe. I don't think we're there yet, but that, in fact, we probably will get there at some point. But it's still probably a bit like China. Maybe it'll be more of a trade unless we get a Draghi, whatever it takes statement, which we don't seem to be anywhere close to at this stage.
Okay, fair. Yeah, and I would say like even some of the European brands are, getting hit quite badly. The Chinese are giving them a run for their money, quite intense.
There's definitely a tiering going on.
Yeah.
So the Hermes and things like this, they're not finding price pressures, but the one notch below that, they're struggling with pricing power.
It's interesting to see where Europe comes, right? So yeah, if our audience would like to connect with you, is LinkedIn the best place?
Yeah, LinkedIn's certainly the best place for me.
Okay. Thank you for your time.
Thank you so much.
We hope you enjoyed today's episode. I understand that we probably introduced quite some new things in today's episode. It's a foray for us, right? Because we hear a lot of these things, amongst our small little community, and we want to kind of take the first step. Right. So if you have any specific and technical difficult questions, please put in a comment section. Maybe we'll have Steve again. Right. So let's see. Okay. Thank you for your time. Okay. See you next week. Bye.
Okay, bye.
See you. Take care.